Welcome back, dear traders. Our analysts are ready to share their market review, latest news, and ongoing trends. On a Wednesday, Wall Street had another hectic trading session. The major indexes closed the highly volatile session with the minor losses. Today, investors are braced for market turbulence. Wall Street indexes incurred moderate losses. The Dow Jones closed 0.7% down, the Nasdaq inched down 0.15%, and the S&P500 shed 0.5%. The benchmark stock indexes accelerated their decline in the New York pre-market. The S&P500 is expected to trade in the corridor between 3,650 and 3,790 points. The red-hot inflation data put investors on edge. Market participants have priced in the rate hike by 75 basis points in the next Fed's meeting. Now investors are speculating on the likelihood of a rate hike by 1%. Amid the raging consumer inflation, analysts are mulling over the prospects of an economic downturn. The Bank of America warned that the U.S. economy would slip into a recession in the second half of 2022. So American households would buckle under the inflation. Besides, the International Monetary Fund is going to downgrade its forecast for the global economic growth due to escalating headwinds. As for the economic calendar, the US PPI did not match the forecast and rebounded to the February reading. Producer prices increased 1.1% on June on months, the highest score in the last 3 months. Analysts had projected a more modest rise to 0.8%. The annual rate of factory inflation jumped 11.3% and fastest growth since 11.6% in March. On the other hand, the core PPI, excluding volatile producer prices of food and energy, edged down to 8.2% on a year from 8.3% a month ago and to 2.4% from 0.6% in March. The situation is no more optimistic in the banking sector. JP Morgan and Morgan Stanley opened the session of the corporate reports and discouraged investors by dismal results with the escalating recession fears. JP Morgan shares dropped 3.2% on the pre-market after the company reported contraction in profits in the second quarter. CEO Jamie Dimon highlighted new problems, including geopolitical tensions, soaring inflation, and incredibly hawkish monetary policies. All these factors pose a threat to global economic growth. Shares of Morgan Stanley fell 2.6% after reporting lower corporate profits. In turn, shares of other banks such as Wells Fargo, Goldman Sachs, and Citigroup also traded lower. Twitter is extending its losing streak. Today, the social media platform was unavoidable due to a serious failure. More than 27,000 users in the US reported error messages. The platform also failed in the UK, Mexico, Brazil, and Italy. The US dollar is setting the tone on the currency market. Yesterday, its index climbed to 109.10, having printed a fresh 20-year high. Bearing in mind recent economic data, the outlook for the greenback remains bullish. The intraday corridor for the index is seen between 108.60 and 109.20. Prospects of a more aggressive monetary tightening and global risk aversion set the stage for the US dollar's rapid rally. Its index has gained about 14% this year. Having weakened to the parity level with the US dollar for the first time in 20 years, the euro slipped to 0.9953. The yen is trading above 139 for the first time since 1998. The European Commission has downgraded its forecast of the EU GDP growth for this year and 2023, wherever it raised the inflation expectations. Unlike the sluggish European economy, the US Fed looks extremely hawkish. The weekly update by the US Labor Department showed a significant change in the labor market last week. The number of initial unemployment claims increased by 9,000 to 244,000 last week, whereas economists had projected a rise to 235,000. The reading is the highest since November 2021 because more and more companies have to fire employees and economic uncertainty. The Canadian dollar is extending its weakness. The USD CAD pair grew 1.71% to trade at 1.32, the weakest level in 19 months. The currency pair is likely to trade in the corridor between 1.3060 and 1.3220. Yesterday, the Bank of Canada raised the overnight target rate by 1% to 2.5%, the level unseen since 1998, and this caused analysts to go to the predicted rate hike by 75 basis points. The regulator signaled that it would continue rate hikes at following meetings to curb soaring inflation, and this fact did not hinder the loonie's fall. Currently, the Canadian dollar lacks support from oil prices. Brent crude declined 3.3% to trade at $96.36 a barrel, and WTI lost 3.77%. The data by the American Petroleum Institute indicate waning demand in the United States. Oil deliveries contracted to 18.7 million barrels a day, and it's the lowest reading since June 2021. At the same time, China has put a lid on crude imports, and this also affects demand for oil. As for the crypto market, Bitcoin is desperate to recover. However, it retreated to 19,700 in the early American session. If the crypto fails to defend the high of $19,500 today, it will decline to 19,200 and lower to 18,800. Thus, the trading range looks like an optimistic scenario, as the price might even touch 20,200. By and large, the token is likely to retest recent lows, and with a correlation with the one stock market. Once again, let me warn you about high volatility during the New York trade, and see you tomorrow.